It is waking up to over the past week or so that the window for a hard landing this year is closing very fast. Because what do you need for a hard landing to occur? You need, obviously, chaotic deposit outflow from that regional bank story that we feared about 3 weeks ago. Actually, we saw small bank deposits up last week for the first time since Silicon Valley failure. And then the other thing that you need is an overzealous Federal Reserve. And we kind of saw snippets of that in early March when the Fed was talking about becoming more aggressive. And now the market is waking up to the fact that maybe they won't ease in the back half of the year, but that's okay because we don't have a hard landing. But the terminal rate, that rate that they stop at that we've been looking for since March of last year, is finally within sight. So we only have like one more hike left, we believe, and then they're on hold. And from an asset allocation perspective, if stock and bond volatility drop, that's a really, really supportive environment for the balanced approach.
Urian, I want to get your thoughts on this. The activity we've seen, the S&P finishing at 41.51 to kick off this new week. I mean, the other piece of the puzzle, though, is earnings, and those are really just getting started now.
Yeah, so earnings season is really underway now. We had the big banks report, of course, late last week, and the numbers have been very good. And they highlight, kind of this dichotomy that we've been looking at in the market where, you look at the most inverted yield curve in decades, and you wonder when that shoe is going to drop. But then you look under the hood and you look at the fact that, the big banks are paying a deposit rate of, 0 to 0.5%. And if that's how you define bank funding versus what they are lending or buying with their assets, the yield curve actually is extremely positive still. And you can make the same argument with homeowners having refinanced their mortgages in 2020 and 21. Most of the currently outstanding stock of mortgages was originated back then when rates were at historic lows. You apply the same math to corporates refunding their debt, terming it out a few years ago. And it makes you wonder if the economy has become mostly immune to rate hikes, with the exception, of course, of some of the smaller banks or even not so small banks that we saw in the headlines a few weeks ago. So, earnings, I think the market is looking at a relatively modest earnings decline that will reverse later this year. And I don't know if that's going to be the case or not, but I think that's what the market is looking at when you look at the consensus earnings estimates. And if that's the case, the market can easily look through an earnings valley when it has the promise of at least, easier liquidity conditions down the road. Okay. I don't think the market can look past an earnings abyss, but that's not what's in the price, and it's not necessarily what I'm expecting. And revenues per share are still making new all-time highs, actually.
Okay, but on the other hand, right, Bob Pisani was just saying last hour that if you look at the VIX, maybe there's complacency. I don't get how, say, over the next 6 months, how do things slow down enough, right, to cool the economy down to where we don't need further hikes and inflation is under control, but not too much, right? Is that just the perfect Goldilocks scenario that isn't likely? How does that happen, Phil?
Well, I think to be underweight stocks here, you have to believe in a slowdown that's not priced in. Okay, so the VIX is actually reacting to rate volatility, in my opinion. Rate volatility was up 100% last year. So I think the VIX at 17 is basically, again, saying that the boogeyman in the room last year, which was this incredible rate hiking story, is just going to take a back seat this year. So I don't think it's Goldilocks. Goldilocks is the no landing scenario. That's premature. So the no landing, but a soft landing, John, could still be plus or minus 1% on GDP.
The unemployment rate is still so low, and inflation is still pretty high.
But I think the signal are wages, not the unemployment rate. Because you can keep the unemployment rate really low because of mismatch of supply and demand. The unemployment rate really is only going to go up if you get a hard landing. Again, not our view. The wage story and the move that wages have made, I think, is the bigger story right now than the unemployment rate or initial jobless claims or continuing claims. I think it's the wage story. And that, I think, gets the Fed to slow down.